Hello all, welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani here. The big sector rotation, well, we've seen it starting this year, and it's increasing interest in one area of active management, and that's market timing. Can you successfully move in and out of sectors and actually make money doing that? Let's talk to Tim Arthur. He runs the main sector rotation ETF. The symbol is SECT. Wes Krill is the Vice President of Research at Dimensional Fund Advisors. He's been studying market timing efforts for decades. Dave Noddick, our old friend, Director of Research at ETF Trends, he also joins us. Kim, there's a lot more interest in market timing and rotation this year. I don't know if it's just in the air. Is that because we've seen so much rotation in different sectors this year with, the reflation trade coming to fore and tech kind of taking a back seat?
Yeah, Bob, good to hear your voice. There's definitely been a lot more in the air, as you say. If you really can pinpoint it, it started at September 1 of last year. And just to give you a real kind of like a real live data point there, from September 1 of last year, value through Friday, value's up 19%, 19, growth is up 2, and how about the Mag 5, Microsoft, Amazon, Apple, Google, and Facebook? They're down 1. They're down 1 during that time. Why has that rotation happened? We think that after people realized there was not going to be a double dip recession, rates bottomed in August, and as they saw them starting to move up, that's when you get the rotation that goes into the value and cyclical plays and the small cap. And it's been historically, it's happened with that as people start to see real rates. We went from negative 45 basis points in the 30-year to where we're now positive 11. So all the tailwinds were all lined up for it to happen, and we're seeing the results, and we think it probably continues for a while.
Now, you've got this sector rotation ETF, SECT. You move in and out of sectors, ETF sectors, not stocks, and it's been outperforming the S&P year to date because you've had it seems like increased bets on banks, energy, and small cap ETFs. How do you decide when to rotate the portfolio? I don't mean describe what's happened. I mean, when do you actually rotate more into energy and rotate out of technology? What criteria do you use? Just briefly describe that. I don't want to know how the market is doing it. When do you decide to get in and out?
Yeah, great question. So there's two parts to it, Bob, in our process. The first is valuation. We're big fundamental value people here. So we've got all kinds of data on looking at sector size and style for its historical valuation, its price to book, price to earnings, and dividend yield. So we look at that, and it gives us a menu to choose from. But the menu alone is not enough. You need to have a catalyst. You've got to have a catalyst. So what we looked at with the financials, for instance, is a steepening yield curve typically has been very, very bullish for that. And then you throw on top of it where they were prohibited from buying back stocks, they were green-lighted in the middle of December. So that's another tailwind for them. Or on the energy side, you had two big things going on. You had 7% of the global supply taken out of the global area during the pandemic. And we know with the vaccine rollout that's going on here, demand is going to pick back up. So demand was going to exceed supply. But even more importantly, here in the U.S., we have an administration that is curtailing supply on federal lands where there's 20% of the supply that comes out of that. So again, it's the process for price, valuation, and then a catalyst.